unlocking the secrets of savings rates. Maximize your money today. A year ago, we found ourselves in a world of soaring interest rates, thanks to the European Central Bank, ECB, hiking rates one after another. Borrowing costs skyrocketed, and while savers had the chance to earn more, the increases in savings rates were painfully slow. It seemed like a golden opportunity for savers, but little did we know that the tides were about to turn. As inflation across the EU began to ease, the economic landscape shifted dramatically. The ECB started cutting rates, which meant that the potential gains for savers dwindled. Many Irish savers found themselves caught in a web of confusion, fear of making the wrong choice, and a general sense of apathy, leading them to miss out on better savings opportunities. Currently, Irish households are sitting on a staggering €160 billion in savings, but the majority of this money is languishing in accounts that offer little to no interest. Over the course of a year, the interest earned on these deposits amounts to a mere €196 million. However, if everyone moved their funds to an account offering just 1.4% interest, that figure could skyrocket to €1.96 billion. Recently, Brokers Ireland raised their voice, urging the government to tackle what they call the disproportionately poor savings rates available to consumers in Ireland. So just how poor are these rates? According to data from the central bank, a whopping €140 billion of Irish deposits are stuck in overnight accounts, earning an average interest of just 0.13%. Brokers Ireland's Deputy Chief Executive, Rachel McGovern, emphasized the need for immediate action, stating the government should introduce the recommendations from its own fund sector review to help consumers get better returns on their money and eliminate the tax disincentives that keep them stuck in low-yield bank deposits. While banks have faced criticism for their meager rates, they argue that better options do exist, but it's up to consumers to seek them out. As ECB rates climbed throughout 2023 and 2024, many mainstream banks began offering rates above 2% for 12-month term investments. Yet, despite these rising rates, only about 5% of Irish savers have moved their money into higher yield accounts. Now, we find ourselves in a different scenario, with the ECB cutting interest rates almost monthly. Just last month, they announced their 7th rate decrease since June, bringing the lending rate down to 2.4% from 4.5% a year ago. Derek Cassidy from Bonkers.ie warns that savers will need to find smarter ways to manage their money as further cuts to savings and deposit rates are likely on the horizon. So, what are the savings options available to you? Let's break it down. 1. Mainstream banks. These are the go-to for many, despite their past missteps during the economic crash over 15 years ago. People still see them as a safe choice. 2. State savings accounts. These accounts come with the perk of no deposit interest retention tax, DIRT, which means you keep more of your interest. 3. Fintechs. Companies like Revolut and 26, Bunk, Raisin, and Trade Republic are gaining popularity, offering better returns and easier access to your money. Notably, Raisin and Trade Republic provide access to interest rates from banks across 12 European countries, with deposit protection up to €100,000. 4. Credit unions. While they don't pay interest on investments, they do offer dividends and are beloved for helping those who might struggle to borrow. 5. Insurance companies. They provide savings or pension investment products, which can yield better growth over time, though returns are never guaranteed. 6. Stocks and shares. For the adventurous, there's the world of stocks and shares, and for the bold, the realm of cryptocurrency. Now, let's take a look at what's currently on offer. AIB, 3% in its online regular saver account for up to €1,000 per month, but rates drop to 0.25% for amounts above that. Fixed-term deposits range from 1.5% to 2.75% for sums of at least €5,000. Bank of Ireland offers a 3% rate for 12 months on a maximum of €2,500, dropping to 2% after that. Plus, you can get €100 back on home or car insurance if you open this account. PTSB, their online regular saver account, offers 2.5% on savings up to €1,000 a month, but anything above that earns almost nothing. EBS, Their Family Saver account promises 3% for the first year, dropping to 1.25% after, with a limit of 2 withdrawals per year. Bunk Free offers an AER of 2.51%, with no regular deposits required and interest paid weekly. Trade Republic, currently providing rates of 2.25% for regular savers. For lump sums, Raisin is leading the pack with 2.76% for a 2-year fixed term with Privat Banka in Slovakia, or 2.7% with Haitong in Portugal. Closer to home, the 10-year National Solidarity Bond from State Savings offers an AER of 2.01% with a total return of 22%. Their 5-year savings bond promises a 1.74% AER with a 9% total return, while the 3-year bond offers a 1.3% AER with a 4% return and a government guarantee. Keep in mind that these funds are locked in for the duration, so make sure you won't need the cash for a while. The upside? No dirt on the returns. If you have personal finance questions you'd like us to tackle, feel free to reach out at onthemoney@irishtimes.com. And if you missed last week's newsletter on financing a new car, you can catch up here.